Thank you, Greg. It's always great to see so much of crowd on a Friday afternoon, and that shows why indexing matters. In a conference which is more focused on active management and fund management, seeing such a crowd on indexing matter is very crucial. So what I'm going to do is that I'm going to focus on some of the trends that we are seeing in industry. So I'm not just focused about products which are MSCI based, but you can see that some of the products and the trends that we are seeing from MSCI is also seen by my competitors in FTSE and also in S&P. And that trend is reshaping the way investors are going to use benchmark going forward. So some of the trends that I'm going to discuss is something is going to happen in the Colombian market also. So I'm going to start with some basic notion what has happened in the world of indexing. Okay, so Craig talked about the story of indexes and index evolution. Dow Jones was the first index which came up in about 100 years ago, more than 100 years ago now. So what happened at the time was that people who invested in the equity market were more focused on their domestic equity. So if you see on this slide out here, starting from my left side, you can see that people, when they went to the equity market, they were buying maybe the US equity. So if you're a US investor, you will invest in the US equity. Later on, as the notion of emerging market came in, they started to allocate to emerging market equities also. Today, when people talk about investing into equity markets, they're actually talking about a broader allocation to all the different markets which exist, which are open to the investors, to the extent that they're also going to frontier markets. So today, when Colombian investors are going, I was meeting a lot of AFPs in the last 2 days. Many of the Colombian AFPs are actually not thinking about just the Colombian equity market. They are thinking about global equity market. So that's one of the biggest challenges which comes up when you go outside of the US, your own market. Then you are talking about different currencies, different custodial relationship, and different broker dealers. How do you actually get access to that? So that's why the power of index comes in, because if you have an index which pretty much create an opportunity to represent to the global market, then you can definitely have an ETF which will track it. And so you can get the exposure of that particular index of the global equity market by just buying one single product via ETF. Okay? So that's why it becomes very crucial that investors, as they're growing in, to understand that how indexes are constructed, how they're putting that together into a global context so they can use an ETF to capture that, the performance of that. The second thing which is happening in terms of trends is what Craig talked about, what Guillermo talked about is factor investing. So let me spend, instead of going into mathematics and everything, let me probably spend some time explaining what are factors of factor investing. So I gave this analogy. I was in Chile last month, and they just won Copa America for the second time in a row. So they are actually a momentum factor, So if you think about factor investing, they are a momentum factor. Then we saw a Euro Cup happening, isn't it? And then we saw a small country like Iceland going all the way to quarters. So a small country, which is a population of 100,000 people, only 100 actually professional soccer players are there, and they all went to the quarters. So they are like a small cap. It would do better in a certain point of time. And then there was Brazil, always crying, and we're trying to discover what's happening. But they are doing well in the Olympics. They just beat Denmark 4-0. They scored 4 goals. So they're like value invested to be we're trying to extract their value. And finally, I saw one team which reminded me of active management, and that was led by Messi. They always promise but never deliver. So in simple way, that is all about factor investing. If you remember what is factor investing, it's all about trying to understand what drives the market and how you can capture that. So let's try to move on to the next phase of interesting thing which is happening is, I talked about global investing. I said that markets are opening. I talked about how frontier markets are getting opened up. We are talking about Saudi Arabia is opening up now. So one big market which is slowly opening up to investors is the China market. Okay, today if you get access to China equities, actually those Chinese equities that you're getting access to are only available for foreign investors. Now, what has happened in the last decade or so? There is another set of securities which we call China A securities. Here, if you look at the the different classes of share classes of equities which are in Chinese market, they're like alphabet soup, A, B, C, D. It reminded me of something in Mexico. Even in Mexico, they had those many share classes. So in case of China, what's happening is this China A equity market, which was so far confined to only local investors, is now slowly being opened up for foreign investors. Okay, so as foreign investors are getting access to this particular set of market, which is pretty much restricted, if you want to get access to that, you have to apply for quota, which is some of the trend which we have seen in emerging market. If we look at the legacy emerging market like Taiwan, Korea, and these markets slowly opened up to foreign investors. So in case of China, this Chinese equity market is, as they're opening up, firms like MSCI, FTSE, and S&P, we're all thinking how to integrate that as part of a global investing or global indices. And some of the FFs already have included that. But why is it so important? Why this Chinese equity market is so important? If you look at from the context of total opportunity set that you see in the emerging market, today the amount of Chinese equity in the emerging market index, like MSCI Emerging Market Index, represent maybe about 20-25% of the total benchmark. Okay? Not sizable, it's still sizable compared to the other markets, but it's not dominating the benchmark. So if you look at the last pie chart where we said if suppose China A gets completely opened up and MSCI decide to include the entire piece of Chinese equity market in its emerging market index, the weight of China A or China itself will be representing about 40% of the benchmark of emerging market. Okay? So that is something is very sizable. Because if you look at the other smaller market, whether it's Colombia or Peru or any other smaller emerging market, their total compensation or the weight will get impacted because of the inclusion of China A. So this is something which we have been consulting with the clients. We're saying that how this should be included, what is the phases you should want China A to be included. But more importantly, for our emerging market and emerging market investors, this has become such a sensitive point that if China A becomes part of the benchmark and Chinese weight in the emerging market index has become quite sizable, what will happen to their own country allocation? What will happen to the flows which we are seeing in the Colombian market? Okay? But there'll be outflows from the Colombian market or Chilean market and Peruvian market. So this is something which will happen eventually, but something which investors should be aware of. And this is not just the MSCI thing, which is happening with other index providers. The other big trend in emerging market is the inclusion of, I said, China A, but there are other markets which are coming to getting included. So we saw this notion of BRICS and everything, but there are fewer other markets which are getting added to. Saudi Arabia is one good example. And Saudi Arabia is another big market which so far was in the fringes, was only open for Gulf countries. And what we have seen is that many of the investors who are going into emerging market are actually trying to capture the beta of the market. So still they are saying it's a high growth economies are there. The growth rate of, if you look at even China is slowing down, it's still growing at 5 to 6% compared to what is happening, the growth we have seen in developed market, which is probably 1 to 2%. So investors who are going into emerging market are thinking about the future long-term prospect, which is in the emerging market, and trying to capture that via indexes and via ETFs. Now I'm going to go to the few other trends which we are seeing. One trend which we have seen happening, especially in the context of global investing, is small cap investing. So if you look at what happened historically, if you go back to the history of the US investors, they went into large cap and mid cap market via S&P 500. Then as they gained access to that segment of the market, they slowly started moving into the small segment of the market via Russell 2000 index. So the popularity of investing in equity market probably started with the large and mid cap, the companies they were very familiar with. So they started investing in that segment of the market, first through active management and later on through index-based strategies, passive strategies, or ETF. And same thing happened on the small cap trend. They used to employ small cap managers, and they found the small cap managers don't beat a benchmark like Russell 2000. They started to go and employ and invest in Russell 2 strategies via, again, index funds and passive ETF strategies. Now, in the same trend we are seeing in the global markets, okay? So investors who are EFA investors, so developed market ex-North America investors, have started to go into the small cap, EFA small cap strategies. Those investors who are emerging market investors have started to go into emerging market small cap indices. So this is something which is a phenomena that we're growing, because if you look at the overall capitalization of large and mid-cap, they cover roughly about 80 to 85% of the overall market, global opportunity set. So you're missing roughly about 15 to 20% of the total market cap. Now, if you are a global investor, why do you want to leave 20% of the market cap on the table? And you can see the performance-wise. If you see some of the performance of the small cap premia, which we call small cap premia, exists not only in the US market, but across the globe. So whether you're going to Europe, Japan, and even small emerging market, you see that small cap in the long run have provided a premium compared to large and mid cap. But again, it's similar to a smart beta or factors. They are quite cyclical in nature. But the idea is that if you really want to capture the entire opportunity set, definitely want to be in the small cap. So this is one of the biggest trends that we have seen is that clients or investors or pensions who are involved and allocating money into large and mid cap are slowly going into the small cap segment of the market, both in emerging market and also in developed markets. The next big trend, which I think is going to impact globally all the index providers and investors, is what we call as environmental, social, and governance indexing, or indexes and benchmarking in investing. So what are these? If you go back to these three themes, there are three different pillars who have been botched and meshed up together, and they don't make sense together to be together. But fortunately, unfortunately, this has happened, so we can't change it. So ESG is basically a way of investing, which is a little bit different from the traditional way of thinking about investments and into the financial market. So investors who are now going into, say, global markets, they're thinking that when I'm going to invest in companies, I'm looking for companies which are more environmental friendly, companies which are not going to create issues for the environment, polluting the environment. So a lot of mining companies, back in the days, they will just drill, take out the mine, the ore, and then what they're going to do is that all the sludges and everything will be thrown into the river. So as regulators are scrutinizing their work ethics and work practices, the investors in those companies are also thinking that if the companies don't change their way, the regulators will going to come and go and after them and put a litigation and become an environmental issue for the company. So in that context, what's happening is that the investors are saying that if I'm going to own a company, whether it's BHP Billiton or Vale or Rio, if these guys don't do their job well, it's going to impact their EPS in the long run, and they're going to underperform. So it's not only on certain sector, it can happen in pharmaceutical. We saw Valiant underperforming because they were doing criminal practices, which was happening there. So most of the investors who are going into the equity market or even fixed income are looking into these strategies, ESG, in much more careful manner. So this is going to be a trend which is not going to be impacting just the global investor outside of LATAM. We have seen that already some of the larger asset managers in the region, like Sura, is trying to implement these strategies within their investment processes. So you will be hearing more and more about this in maybe next few conferences, and few years as you go and say ESG and low carbon investing become a big theme in this region. And finally, I'm going to close down by talking about one more trend which is happening, and this will be very crucial for you, and this is more related to what we have seen in the world of sector classification or industry classification. So as you know that there is an industry classification which has been co-partnered and co-authored and co-created by MSCI and S&P. It's called the Global Industry Classification Standard. And so far, that classification standard had only 10 sectors, okay? So one of the sectors, financials, is getting split into two. We are going to create a separate real estate sector, which is happening August. Is it August? Yes. Yes. September is going to be, from end of August, September is going to be. So that means if you are an investor so far, who are a sector-based investor, and you are thinking about only 10 sectors, now you're going to have 11 sector into the play, which is the real estate sector. So that you're going to see more and more products being created around sectors now. And there are different ways of capturing the sectors. And one way of thinking, simple way of thinking is that not just buy the entire sector, look for companies which are more focused on real estate operations and management rather than just providing services to real estate. And in the long run, we are seeing this is called core real estate investing. So companies which are more focused on real estate. You can actually go and extend the concept of smart beta or factor investing into real estate also. You can create a low volatility sector fund, okay? So those kind of stills that you saw in a traditional cap-weighted benchmark, you can also apply in the real estate world by tilting the real estate sector into various components, whether high dividend or low volatility, or even small cap also, okay? So that's one thing. The third dimension to that is actually, you can actually create an index which captures the private real estate. So you can combine your core real estate, combine that with a inflation-protected bond, and create a much more, what we call as a much more smoother performance of real estate. And the reason is that if traditional real estate indices or equities are leveraged companies. So if you want to remove the leverage component, you have to include some amount of de-smoothing effect, which is need to be required, and that's why you include an inflation component to that. So what we are seeing in terms of, you have to summarize, there are basically 5 or 6 trends which are happening in the equity world or indexing world. And that will reshape how investors have so far approached either benchmarking or their investment processes. One of the biggest one, if it's summarized, is the world of factor investing. So think about Chilean soccer team and the Brazilian soccer team. So that's what factor investing is. Second biggest trend, I'll say, is the ESG. So environmental, social, and governance approach of investing. And third dimension is the global investing, going and capturing the entire global opportunity set rather than be home biased and just focus on Colombian equity market, but think about global opportunity and looking for a broader opportunity for, via ETF or index funds, okay? With that, let me close down and then we can have more time for discussion. Thank you.